You are on the Transparent FX Academy. I'm Nick, and I'm a top author on TradingView, and in today's video, we will be breaking down a pair both from a technical and an order flow perspective to understand where are the best probabilities for a trading opportunity on the pair to obviously be capitalizing on it. So the video will be both very educational and practical, so without further ado, let's get straight in it. The pair that I want to speak about today is CHF JPY, and the reason for which I want to speak about CHF JPY is because the pair is very near to providing to us a good trading opportunity, so I obviously want to share a full breakdown of the pair, and as usual I will keep this analysis as educational as possible. First, we will be speaking about this pair from a technical perspective. We will then go and see what we have from an order flow perspective with the commitment of traders. So what hedge funds, so the non-commercials in the market, the biggest speculators in the market, are doing both from a CHF and from a JPY perspective. And by the end of the video, you will know exactly what kind of opportunities we can be looking for on this pair. So without further ado, let's get straight into the analysis. Now, starting here from the monthly time frame, what we have is a market which has just provided a nice impulse and correction. Now, after an impulse, if you want to measure a correction, what you have to do is take your Fibonacci from the low to the high of the impulse. And if we take our Fibonacci from the low to the high of this impulse, what we can see is that the market has just retraced exactly to the 50% of the Fibonacci taken on the impulse, and then the next step was the 0.382. Now, this is a very common behavior of the market. The market first tests a 50% or 0.618 Fibonacci retracement and then moves to the next one, basically touching the Fibonacci's one by one, which is exactly what we're seeing in this specific situation. Now, if you're asking yourself, why did the market stop exactly at the 50%? The market stopped at the 50% because the 50% was the Fibonacci level aligning the best with the previous resistance, not our support. So we had a 50% lining up with the previous resistance, turn support, which creates a confluence of support inside of this area from which we definitely did expect the market to provide this continuation to the upside. What we also had was this candle here. Now, when you see a candle like this, a candle with a green body and a quite long wick, what you expect is for the next candle to fill in this wick, basically creating the continuation to the upside. That is a pattern that you see over and over again repeating itself in the market, and I also made a video just about that pattern. Going down on the weekly time frame, what do we have? Now, from a weekly perspective, price action is quite clear. We have a market which has just created a very strong impulse to the upside, but in creating this impulse to the upside, the market has also provided a bearish pattern. The bearish pattern that I'm speaking about is this overextended W formation. Now, after an overextended W formation, what you want to see is the market create a retracement. Specifically, you would like to see the market create a retracement to the 0.32 of the Fibonacci taken on the impulse leg. So you expect the market to create this move to the downside here. Now, if we go and see what we have here, we can see that the market is also exactly at the previous high, which is a strong supply area for the market. In general, when you have a high in the market and the market is approaching it, that is acting as strong supply. So all this zone here is strong supply for CHF JPY, from which we do expect the market to provide a rejection to the downside. Going down on the daily, what do we see? Now, from a daily perspective, price action is quite clear. First of all, we had spoken about CHF JPY quite a few times in the past. I spoke about CHF JPY when the market was here. I made a full breakdown explaining all the reasons for which from here we wanted to see the market create this move to the upside, and that is exactly what the market did. Then the market created this W formation, and after this W formation, I made a full breakdown of CHF JPY, explaining all the reasons for which from here we wanted to see the market create this move to the downside to complete the pattern at the neckline, and again, that is exactly what the market did. Then the market created this continuation to the downside, and when the market was here, I made a full breakdown explaining all the reasons for which from here we wanted to see this move to the upside, and again, That is exactly what the market did. Then we had the creation of this W formation, and when the market was at this level, I made a full breakdown explaining all the reasons for which from here we wanted to see this move to the downside. And again, that is exactly what the market did. The market also then created this M pattern, after which I made another breakdown explaining why from here we wanted to see first a move to the upside, then retracement to the 0.32 of the Fibonacci taking on the impulse, and then the continuation to the upside, which is, by the way, exactly what the market did. And I will link in description all this previous analysis. You find all this previous analysis linked in description, so you can go and check it out for further reference and more free education. Just a quick reminder, make sure you comment below and you let me know which pairs or topics you would like me to cover or analyze in the next videos. But at the moment, what do we have and how we can be looking to capitalize on the next move for this pair? Now, looking at this structure that the market has provided here, from a daily perspective, we can see that in all this impulse to the upside, there is one candle which is not related to the move, which is exactly this red candle here. Now, since this candle is not related to the move, it is a strong structure area for this market. Specifically, since the market is above the zone, this is a strong demand area for this market, which the market has already tested with this candle here and rejected to the upside. So even though from the weekly time frame, as we have already seen, since we have an overextended W formation, we would like to see the market create a move to the downside. On the daily, we do realize that we still cannot be looking for the shorting opportunity because the market is still above support, basically above this candle here, which is previous resistance, which is now turned support at this area, and the market has also already respected the zone. So how we will be approaching this kind of situation with students, a situation in which we have a bearish pattern from the weekly time frame, but bullish structure from a daily perspective. Now, before I show you this, let's first go and see what we have from a COT perspective. So commitment of traders, which is what hedge funds are currently doing in the market. And let's see what hedge funds are doing both on the CHF and on the JPY. Now, starting from the CHF, what we can see is that with the last report, hedge funds have opened 1K short positions and closed 3.1K long positions. So in this move to the upside, hedge funds have started adding shorts and closing longs, which is exactly what we would like to see for the move to the downside to happen from a weekly perspective, as we have already seen. And if we go and see what we have on the JPY, we can see that on the JPY, net positions increased from 29.6K all the way up to 48.1K, with another 1.1K longs added with the last report, bringing the long positions from 54.4K all the way up to 63.5K and only 15K shorts. So the JPY is very strong. So we have a strong JPY and a weak CHF, which is exactly what we need for this move to the downside. The only question is, will the market first create a higher high to go and grab all these stop losses that are above this area, basically for a stop hunt before the move to the downside, or will the market already start the move from here? Well, that will depend on whether or not institutions have already loaded up their positions. But generally speaking, okay, trading is not predictive, trading is reactive. And the monthly, weekly, and daily timeframes combined with the COT data are the best timeframes for the direction of the market, but they must be aligning. And in this case, they're not aligning because the daily timeframe still has support. So until the market will remain above this support, the market can easily create the move to the upside. And it actually should create the move to the upside because the market is still above daily support. So if we are to be looking for a shorting opportunity, we first need to wait for the daily structure to break, meaning that we need to see the market create an impulse to the downside that breaks and closes from a daily closing perspective below this zone. Only at that point, this previous support will be turned resistance because, as you know, in the market, once a support area is broken, it is turned resistance. So after the break, on the retest of this structure inside of here, this is exactly where we will be monitoring price action with students from a 4-hour perspective. Why 4 hours? Because the 4-hour time frame is the best time frame for direction for confirmations and entries, because obviously, as I just said, monthly, weekly, and daily combined with the COT data are the best time frames for the direction of the market. But the best time frame for confirmations and entries is always the 4 hours. So if the market will manage to break and close below the structure, then this previous support will be turned resistance here, and after the break, on the retest inside of this area, this is where we will be monitoring price action from a 4-hour perspective with students, waiting for the market to provide to us one of our valid entries. And as soon as the market will provide to us one of our valid entries, we will be taking a nice short with a very good probability and very good risk to reward at that point for the move to the downside and completion of this impulse correction and impulse pattern to the downside, and for the market to complete the weekly pattern, weekly overextended W formation that we have already identified from a weekly perspective. But until the market will remain from a daily closing perspective above this support, we cannot be looking for any kind of shorting opportunities. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free analysis, education, and updates for all of you. You can also go and check out the mentorship program. You find the link in the description. It's a very complete program. You first learn all the rules of my rule-based strategies, and then you trade them live with me. Every single day you get a new daily market breakdown showing you exactly how to apply the strategies with entries, stops, take profits, as well as having me answering all your questions every single day. So I really suggest that you go and check it out, and I will see you in. The link is in the description.